All right, let's get right into it. Today, we're going to peek inside the mind of a professional trader. We're going to unpack two really fundamental tools they use and get to the bottom of the one core decision every single pro makes before they even think about putting any money on the line. So, how do the pros really do it? I mean, really trade. If you think it's all about having some kind of crystal ball, just guessing if the market's going up or down, well, you're in for a surprise. The real game is it's a lot more subtle than that. It's much more architectural. Okay, so let's just dive right in. The first and honestly the most important secret is this. For a pro, it's not really about having a view on the market. I mean, that's just step one. Anyone can have an opinion, right? Oh, I think oil's going up. That's the easy part. The hard part? Well, that's where the real skill comes in, and it's something totally different. It all comes down to choosing the right structure. And you know what? That word, structure, that's going to be the star of our show today. It's the one thing that separates a wild gamble from a carefully engineered trade. It's the blueprint that turns a vague idea into a risk you can actually measure. So what in the world do we mean by structure? Well, think of it just like the slide says. It's the architecture of your trade. It's the design. It's how you build your position so that you're betting on exactly the market forces you want to. And this is the important part, you're deliberately avoiding all the other ones. It's basically you choosing your own battlefield. Okay, so that brings us to the first tool in the toolkit. We're going to call this one the blunt instrument. This is directional trading. And yeah, it's probably the one you're most familiar with. Yeah, this slide really nails the two main ways to think about this. You've got two archetypes. First, directional trading. That's our blunt instrument. It's like making a bet on the entire ocean. It's simple, it's powerful for sure, but man, you are exposed to every single wave, every storm, everything. Then you've got spread trading, the scalpel. This is like betting on one specific current within that ocean. It's precise, it's targeted, and its whole purpose is to isolate that one idea from all the chaos around it. So let's officially define this thing. Directional trading is, well, it's the purest, most straightforward bet you can possibly make. Your whole idea is just price is going to go up or price is going to go down. That's it, full stop. The catch? You're exposed to literally every single thing that can affect that price. In the biz, they call this Delta 1 exposure. So you might be asking, why would anyone use a blunt instrument like that? Well, because sometimes what you need is a sledgehammer. Directional trades are absolutely perfect for those big, broad ideas. Major macro shifts, a huge change in market sentiment. They're simple to put on, they're easy to keep an eye on, and hey, the profit potential is basically unlimited if you catch a massive trend. They really shine when there's one single dominant story driving the whole market. But, and this is a huge but, all that power comes with some serious danger. Your timing has to be pretty much perfect. You're a sitting duck for any random piece of macro news, sudden market freakouts. Basically anything can come out of nowhere and blow up your trade. And this really gets to the heart of the problem. You can be totally right about your big idea, but if you're just a little bit wrong on the timing, you're still going to lose money. And let me tell you, when these trades go wrong, they go wrong fast, they go wrong hard, and it is absolutely soul-crushing.
So if the sledgehammer is that risky, what's the alternative? Well, it's time to pick up our second tool from the kit, the scalpel. We're talking about spread trading now, and this is all about one thing, precision.
Now, to really get why the scalpel is so powerful, you first have to appreciate all the noise, the chaos that the blunt instrument has to deal with. See, a directional trader thinks they're just betting on their one idea, but they're not. They're also unintentionally betting against inflation numbers, random geopolitical events, OPEC announcements, currency moves. I mean, the list just goes on. And most of that stuff has absolutely nothing to do with why they put the trade on in the first place. And this is where the scalpel comes into play. A spread at its core is an act of risk deletion. That's what it does. Its entire job is to surgically cut away all that unwanted noise, all those random risks you don't care about, so you can isolate that one pure signal that you actually want to trade. So how on earth does it do that? Well, a spread is what we call a relative value trade. You're simply long one thing and short another very similar thing. And by doing that, you basically cancel out all the big picture stuff that affects both of them. So for example, say you're long oil for June delivery and short oil for December delivery. Suddenly, the overall price of oil kinda doesn't matter as much. You've just deleted that risk. Now, what are you betting on? You're just betting on the relationship between short-term supply and long-term supply. See, it's much more specific. And that right there is exactly why professionals, especially the ones with a really deep physical or structural edge, absolutely love spreads. Their whole advantage isn't about guessing what the Fed is going to do next. No. Their edge is in understanding the nitty-gritty stuff, like supply chains, demand patterns, logistics, seasonality. And spreads let them trade those ideas time, quality, location, directly, without getting bogged down by a bet on the entire global economy. But of course, it's not that simple. You knew there was a catch, right? The scalpel. It has its own set of hidden dangers. And believe it or not, in some ways, they can be even more deadly than the brute force of a bad directional trade. This quote from the source material we're looking at, man, it just says it all. Spreads feel safer, right? Their day-to-day moves are usually tiny. But that feeling of safety, that is a very dangerous illusion. The risks aren't gone. They're just different. Okay, danger number 1, correlation risk. In the industry, it has a much scarier name, the widowmaker. And it's exactly what it sounds like. This is that horrifying moment when that stable relationship you built your entire trade on just shatters. It completely breaks down. Your hedge is gone. It just evaporates. And all of a sudden, you're hemorrhaging money on both legs of your trade at the exact same time. It is an absolute catastrophe. Next up, you've got something called legging risk. You see, a spread is one single idea, but it's 2 separate clicks, 2 separate transactions. And if the market moves against you in that split second between executing the first leg and executing the second, poof, your entire profit edge can just disappear before you've even finished putting the trade on. It's infuriating. And finally, there's the liquidity mismatch. Oh, this is a nasty one. It's a trap. Imagine you have a spread where one side is super easy to buy and sell, but the other side is really thin. It's illiquid. Now picture a crisis hits. You might be able to get out of the liquid side, no problem. But you're completely stuck in the illiquid side. You can't get out. And just like that, your perfectly hedged position has transformed into a terrifying, unhedged, directional bet right at the worst possible moment. So, okay, we've got blunt instruments with their dangers. We've got scalpels with their hidden dangers. So how does a pro actually choose what to do? Well, it all boils down to what we can call the master craftsman's rule. You have to align your specific edge with the right structure. And the rule itself is actually incredibly simple. Look, if your edge, your unique insight is broad, you're talking about big macro shifts, government policy, global sentiment, then the right tool is directional, just trade the whole market. But if your edge is super specific, you know something about physical supply or storage levels or a shipping bottleneck, then the right tool is a spread. You isolate that specific thing you know. And what this really means is that there are 2 forbidden mismatches. 2 cardinal sins that pros try to avoid at all costs. First, never use a big, clumsy directional trade for a very specific structural idea. Why? You're just burying your tiny smart signal under a mountain of noise. And second, never use a delicate spread to express a huge directional view. All you're doing is capping your own upside and watering down your conviction. So, here's the real takeaway. The most crucial point of all of this is that choosing your trade structure, it isn't a matter of personal style. It's not about what kind of trader you are. It's a technical decision. It is a risk-shaping tool, plain and simple. It's about being an engineer and matching the architecture of your trade to the very specific nature of your idea. And that really leaves us with the final big question. The next time you have a view, an idea about the market, before you even think about clicking a button, just stop and ask yourself this. Am I betting on the entire ocean, or am I betting on a single specific current? Your answer to that one question will tell you exactly which tool you need to pull from the toolkit.